Welcome. Welcome to Cogent Strategic Wealth, clarity throughout the coronavirus chaos. We're here to offer you cogent advice for the sideline investor. We want you to invest in the future. We want to bring you clarity today, offering you some tips on how you can not only survive the chaos, but also help you better understand what happens on the other side of most market corrections like these. If you're sitting at home, rather than in an office or wherever you normally are at this time, you're probably wondering about your job, your children, your elderly parents, maybe your clients, your kids' online school, so many things. Well, whatever you're doing, in this presentation today, you're going to know how to better prepare yourself to protect your family's financial future, and your assets going forward. You're going to learn about how to have a plan, and a plan that you can actually apply to your everyday use, and some practical ideas on how to apply that plan to your unique situation. You're going to feel confidence, you're going to feel relaxed, and you're going to feel that your financial future is better tomorrow than it is today. We hope in this short video that it'll be a good investment for you in your time, your effort, and energy to watch it. Now, with all the market volatility and chaos around COVID-19 outbreak, many people are wondering, how is this volatility going to affect them? For investors, the volatility and disruptions have been immense. Those disruptions in your daily life, and the threat to your health or the ones that you love. There's also been the market volatility, and all of that brings with it just a ton of emotion, and that's understandable. If you're already fully invested, we encourage you to be aware of the near-term market action, but also to stay put according to your personal financial goals. That's easy to do in theory, not the easiest to execute in life though, and we appreciate that. But now what about those of you that either jumped out to the sidelines during a former market turndown, or in the recent weeks of the news of COVID-19, and how that has panicked you to move out of your investments? What if you have only substantial cash and no investments at all? Or if you just have a few investments at your employer and then a whole lot of money sitting on the sidelines? Is it now time for you to rebuild your portfolio and invest in your future? Well, we hope that the information that follows is just for you. Well, I'm Michael Evans, founder and fiduciary wealth manager at Cogent Strategic Wealth. We help high-achieving individuals develop clear goals for securing their financial future and building a plan to attain them. As a fee-only independent wealth manager, my team and I fill the gaps with proven evidence-based wealth management strategies so that your financial lives are as well planned out as your professional lives. And now I'd like to introduce my co-advisor, Kelly Stanley. Hello, Kelly.
Good morning. As a busy mom and a professional, I know how tough it can be to try and manage a demanding career and a full personal life. Managing your investments, or lack thereof, may not have been at the top of your priority list. However, living through a pandemic and a corresponding shock to the financial markets may have been just the kickstart you needed to take control over your financial future and live your best life. And that's what Michael and I enjoy doing every day with our clients. For most of us, achieving financial comfort, taking care of family, planning for a secure retirement, and making sure children or grandchildren get an education and building a legacy are extremely important. But many of us feel unprepared and ill-equipped to deal with all of them in a knowledgeable way. Adopting a path designed to uncover what is most important to you is essential in order to put together a long-term plan. Today, you'll learn how you can take some simple steps to plan and protect your future, and how you can think about making the best use of your own financial resources to lead a fulfilling life. Today, our goal is to help you understand 5 things that you can do now if you've been sitting on the sidelines, either just recently or have been on the sidelines for a number of years. We will address each of these in detail, but to summarize what we will cover today, in order to have a brighter future, we're going to talk about, while it may be very difficult at times, you need to overcome your own personal instincts. Secondly, need to understand that every day is a good day to invest. We will address the importance of why you need to build an emergency reserve fund. We will explain the benefits of why you need to choose evidence over emotion. And lastly, we will cover how you can best invest in your own future. I'll turn it over to Michael to get us started here.
Thank you. So as Kelly mentioned, we need to talk about overcoming your instincts, how our survival mode brains trick us into poor financial decisions. First and foremost, if you've made past decisions just to sit it out, don't beat yourself up over it. We absolutely believe there is no judgment here. What's happened in the past is in the rear view mirror. You need to look out the dashboard, out through the front windshield, and see the future. So forgive yourself first. And know that your own behavioral biases are often the greatest threat to your financial well-being. Take it as a lesson for what you did. So let's talk a little bit about evidence-based investing behavior. And so when you have evidence-based, it tells us that fear or herd mentality, maybe hindsight or recency biases all work against you. In the current pandemic crisis, there's an opportunity, though, to get back into the market at levels that are off of the 2019 highs. So we want to be able to be poised to get ahead of this and be able to capture the future as you need to. If you do reinvest now, though, should you go all in, dip a toe in? Is it too early? Is it too late? These are all questions that are going to be on your mind. But just know that the idea behind investing is to buy low and sell high. Let me repeat that. Buy low and sell high throughout your life. Yet following that emotional investment cycle, it sparks reaction in decisions that may bring the opposite effect, buying at higher prices and then selling at lower prices due to your emotions. It's extremely difficult to accurately time the market on a consistent basis. Investors are better served by sticking to their plan, first agreeing to it and building it on their unique situations, and then working it throughout their life. The 2008-2009 global financial crisis offers a great example of how that emotional cycle affected investors' decisions. After going through that 08-09 downturn, and some of you right now during the COVID-19 downturn, many investors fled the market, and they were out of the market just before the rebound began. They locked in their losses and experienced the stress of watching the market climb while they were sitting out. Staying disciplined through the rising and falling markets over time can pose a challenge, but I must say it increases the chances for your long-term success. Investing can be an emotional roller coaster. The way our brains are hardwired can really cause us to make emotional decisions about money, and especially at the wrong moments. Markets are prone to sharp, erratic movements. One that we just witnessed here, the fastest drop to a bear market in market history. Those movements can cause investors to sell at inopportune times. Conversely, during strong bull markets, like the one we had at the end of last year, investors often rush into the market because they feel elated and buy at the peak. Ultimately, this kind of emotional short-term behavior can be really detrimental, and it can have serious consequences, including dramatic portfolio underperformance and a lack of attaining your goals. So this is the most opportune time to say this to you as an investor. You must be willing to take the ride through the temporary declines like the one we're experiencing now to be able to participate in the advance of equities of the world's great companies over the long term. People may struggle to separate their emotions from their investment decisions, but you have to not be reactive and have a plan. So that was number one. You have to know yourself. Now, what do you do if you want to go forward? Well, regardless of those past victories or the defeats, we believe that every day is a good day to invest. You might say, are we too optimistic? Well, actually, we look at the evidence and the market history, and it tells us that's true. But you really have to have a fresh, blank slate resolve to forgive yourself and then to move forward. Have no regrets, no judging. You're where you're at today and you need to move forward. So Charles Kettering, an American inventor, engineer, and businessman, once said, "My interest is in the future because I'm going to spend the rest of my life there." We suggest that you adopt that same mentality. In the midst of all this chaos, take inventory of where you're at today. What resources do you have on hand? What are your risks, both personally and professionally? Focus on where you and your family stand in relation to your personal financial goals and how best to achieve them. If you don't have a family mission statement about your goals, sit down today and get a better perspective on where you're at and where you're deciding on where you're going to go. And then apply yourself to that. Now, most people look to the financial markets as their main investment avenue. The good news is that capital markets have rewarded long-term investors. The markets present capitalism at work in our economy and throughout the world. Historically, free markets have provided a long-term return that has more than offset inflation. This is well demonstrated in the growth of wealth in the graph that you're looking at now, which shows the performance throughout the investment indices in high inflation and low inflation times, through other pandemics, through other crises and wars that we've gone through since 1926. These represent the different areas of the stock market joining together and giving a return to investors. It demonstrates the true beneficial role of owning stocks throughout the great world and in creating real wealth over time. The returns a long-term investor can have and receive far exceed those as the biggest challenge to investors, which is inflation. While sometimes it's a bumpy ride in the short-term volatility, such as this coronavirus, stocks have significantly outperformed fixed income or bonds or bank accounts over the long period. Now, let's look at what history shows us as to the gains. Sudden market downturns can be really unsettling. Don't we all know that feeling right now? But historically, U.S. equity returns and those returns across the world following sharp downturns, such as the one we just had, on average, been positive. This graph shows that since 1926, U.S. stocks have tended to deliver positive returns over the 1, 3, and 5-year periods following other peak declines. So no, there is hope. These cumulative returns have a striking effect. If you look at 10, 20, or 30% declines, the compound returns after that, after 5 years, is 50% or more. So what does this tell you as an investor? Well, that there's hope, and that the other side of chaotic times like we're living in today is actually offering us hope in being able to know that we can survive and thrive through this. But creating and sticking to your plan puts you in the best position to capture this recovery. Now, as I said earlier, many investors have bailed out of the market or just never invested because they didn't believe it was for them. Well, as an anecdote to that chaos in their lives and in their minds, we believe that the market experience that you should have should capture the long-term expected returns of the stock market. And to do that, this is a study that looks at what if you were to jump out over a 30-year investing period. So I'm 54 years old. I have a 40-year period I'm thinking that I need to invest. But if you just look at the 30 years, you'll see the impact of missing just a few days of the market. Best days. I'm not talking about the best days in a year. I'm talking about the best days in a 30-year period. So here's a hypothetical investment in stocks that make up the S&P 500. Missing out on just a few of those days has consequences. So take a longer view. Go back 50 years now. A typical $1,000 investment during those 50 years returned over $138,000. So that's from 1970 to close to the end of 2019. But now if you just miss the 5 best days during that very long period, what are you missing out on? Well, instead of the 138,000, you'd only have 90,000 or so. Now, if you miss 25 days, so just 25 days in that long period, how much do you have then? Well, it's about $32,000. So you can see clearly that missing out on even a few of the market's best days each year can have significant impacts on your cumulative returns and actually very big deleterious effects on your ability to retire in comfort. So now I'm going to turn it over to Kelly to talk about how can you survive through those market volatility times.
Well, during market volatility, it's certainly imperative to focus on the things that you can control. When there are pandemics going on and things out of our control, it sometimes is hard to focus, but we need to stay focused on what we can actually control. And one of those things is making sure you have an adequate reserve on hand to cover any potential emergencies that may arise. So just as in investing, your life and overall financial situation can become volatile. Things change. Life happens, and you'll want to be ready for it without having to worry about going into debt to cover any unexpected expenses. So before you even decide to jump into the market, you want to make sure you first have a fully FDIC insured savings account. Now, if you're a 2-income household, we would suggest setting aside enough cash to cover at least 6 months worth of expenses as a first step. Given the current economic environment, though, you may actually want to expand that to a year's worth of essential spending, given we do not know what the depth or length of what stands before us with this pandemic. If you are a business owner, you should consider doing the same for your own business. It's important to put your emergency funds in an account that is insured up to the full FDIC insurance limit. So if your insurance fund happens to exceed $250,000 at an individual level, along with any other assets you may have at one single institution, you'll want to utilize multiple banks just to protect your own assets. And hand it back to Michael now to go over number 4, which is why we choose evidence over emotion in investing.
Great. Thank you, Kelly. So now you've taken the time and the appropriate steps to better understand where you're at and where you're going by developing your family's financial life mission statement, let's call it, based on your unique goals and obligations. So those are like planning for retirement, educating your children, taking care of those who are important to you. And you've also funded a reserve fund so that you can survive the volatility of the market presents to you throughout the rest of your life. Now you've taken those appropriate steps. What do you do next? So now to implement your plan that you have, you need to make investments. And in those investments, you should choose evidence-based investment strategy. You should fight the biases that we mentioned earlier. You should know that it's very difficult to be an investor over the long horizon. You should be cognizant that your brain is not built for investing. None of ours are. You should also fight the chaos and the noise of the media and of Wall Street. We believe you should adopt an evidence-based investing formula for your investments to accomplish all of your goals. So consider how stock markets have delivered long-term returns to patient investors like you. Then adopt evidence-based portfolio management in your accounts. The portfolio will be comprised of globally diversified companies from around the globe. The fees will be low, the tax efficiency will be high, and it'll deliver to you the long-term returns the market can produce. It will also help you sidestep the noise of the investment world and the media. And it seems that there is an unlimited number of approaches to investment management out there. It's understandable that investors like you and me sometimes find themselves confused. They're buried under the never-ending flow of pundit opinions, analyst reports, a new expert on this or that, someone with a hot sales pitch of some kind of product or some kind of method that's going to double your money overnight. Well, just know that this vast array of noise that's out there is actually overcome by research that academics have done for decades. There's 70 years plus of academic peer-reviewed research that we can rely on. So learn why you can trust the market to deliver returns for your money over the long period. Many people think you need to predict the prices that are going to happen and occur ahead of securities, but this isn't required to outperform markets. Many times you've been stuck in traffic, I can imagine, and you've switched from one lane to another, often thinking you're going from a slower lane to a faster lane, only to come to a standstill very quickly. Or maybe you're the driver that's patient and slow, but you watch the person that goes in and out, and eventually you're sitting right next to them at the next stoplight or stop sign. You know how futile it really is. Well, doing this in your investment life adds anxiety and increases the risk of accidents. It really hasn't improved your situation. Well, investing is just like that. Trying to anticipate the movement of the market just adds so much undue risk and so much stress and anxiety. The data says it does not lead to a better experience for the investor. So why do it? So let's give you the two approaches here. Remember I talked about Wall Street and the noise? Well, there's two approaches. The first is the traditional approach. And then there's the evidence-based approach. Which one is right for you? How can you be certain that your investment approach aligns with the principles needed to meet your financial goals? Which one would you choose to weather the uncertainty in the market or even what life has to offer you, whether good or bad? Which approach can bring you the confidence and the security you need? Well, with your financial goals at stake, you can't leave your investment strategy to chance. We believe you should choose evidence-based investing. It focuses on the long-term market history, uses peer-reviewed academic evidence, it's practically applied, and requires only patient participation. It's actually the way to go, and the evidence shows it. Now, you might say to yourself, wait a second, as an individual with a little bit of humility, I'm not as very great of an investor as I should be, and I'm not a professional money manager. But there must be professionals out there with a crystal ball and can see the train coming that's about to hit me from a mile away. Well, when it comes to professional money managers or MBAs or PhDs in finance from the best schools, having the best access to the most amount of resources to outguess the markets, I'll bet you think that they can overcome those hurdles that you can't. Well, researchers have recently studied the performance of actively managed mutual funds and found that even the professionals, those investors with the most resources and the most training, have difficulty beating the market. Over a 20-year period, 77% of equity funds and 92% of bond funds have actually failed at this. They have not either survived or beaten a simple index benchmark. That seems to me to be really difficult to believe, but the research bears it out. So that leaves you almost with a 3 out of 4 chance of not beating a simple index fund, paying higher fees, and just being frustrated. So overpaying and underperforming is never a formula that we could advocate. So we believe you should adopt an evidence-based strategy grounded in academic peer-reviewed research. I'll give you just a few reasons why an evidence-based investment strategy should be utilized to achieve your financial goals. Think about this. Trying to predict the future with breaking news or a tip or anything like that is a losing battle. Understanding that near-term market swings are completely unpredictable, to ignore the noise of market movements, to generate long-term returns, to achieve your goals, you can't rely on the news, on your brother-in-law, on a tip that you receive. Another one is just trying to beat the market creates unnecessary stress and urgency. An evidence-based approach can cause you to make decisions that are in keeping with your long-term goals, not reacting to things on the outside, just actually choosing your own values and your own decisions to be able to move forward. By taking your time and not trying to beat the market, you can actually make informed decisions that have amazing impacts. In our follow-up to this, we're going to offer you our 7 reasons why you need an evidence-based strategy to achieve your financial goals. You can download this on our website after the video cast here. You can download it, but it'll give you much further information. So people that make good decisions in investing trust the markets every day, and we think you should too.
As Michael just mentioned, the last one we want to cover here is why you should invest in your future and why it is so important. Your perception of what your financial future needs are is likely far less than what it will truly be. So for that reason, it's even more important to create an investment plan to fit your needs and risk tolerance. You want to structure a portfolio along the dimensions of expected returns, diversify globally, manage expenses, turnover, and taxes. And most importantly, you want to stay disciplined through market dips and swings. As we all know, that can be very challenging, but in the long run will be most beneficial to you. A financial advisor can offer expertise and guidance to help you focus on actions that add value. This can lead to an overall better investment experience. As we all know, life is uncertain. The markets are even more precarious. Even though your emotions may be running high, you don't want to have knee-jerk reactions with your hard-earned wealth. The market volatility that we are experiencing is a normal part of how our economy works and is a part of investing. We don't know when or how, but we do know the markets are going to correct themselves, and based on the evidence, is bound to return in strength. So now is the time to work with an advisor and create a plan that will see you through to the other side. If you are unsure if your current plan works for you, we do offer a free portfolio check. You can have the confidence to know what you need to do with your plan going forward. Michael will sum up today what we've covered and move forward.
Thank you, Kelly. As Kelly mentioned, if you don't work with a fee-only, independent fiduciary advisor or are uncomfortable with the one that you do have now, take action. Take action by doing these 3 things now. Go to cogentstrategicwealth.com and download our 7 reasons for adopting an evidence-based strategy. Request our Confidence Builder. It's a free, no obligation second opinion service. Even if you're working with another advisor, we'll ask you where you're at and where you're going, and we'll see if your investments and your philosophy, even your amount of return and the products that you use, if they're appropriate for you and your situation. Then the third thing you can do is go to our website. There is a great amount of information there in our resources and under our blog. And you'll also be able to schedule a Cogent conversation for yourself there, which will allow you to be able to get a plan. So now is the time for action. I ask again, what are you going to do to secure your family's financial future?